Welcome to the Skeptic's Guide to Investing with Steve Davenport and Clem Miller. Every 2 weeks, Steve and Clem bring you brief investment insights you may not find anywhere else. We hope you enjoy today's episode. Here are Steve and Clem.
Welcome, everyone, to our first podcast of 2025. It seems unreal after going through the conversion to the 21st century that we're already a quarter through this century, but it's time flies when you're having fun. And we hope to have some fun with the podcast this year and continue to satisfy everyone's interest in markets and being a little skeptical about them. And I guess I would say that our skepticism barometer is pretty high right now. It's going to be an interesting year, and we want to start today with a discussion about going beyond the Mag 7. We've heard about the Mag 7 for the last year and a half and all about artificial intelligence and what the future is going to hold. And a lot of futuristic earnings have been built into these names. So today I'm going to ask Clem, what do you think? Are there investments beyond the Mag 7, Clem?
Okay, so I'm going to back up a little bit and say that I think that, as we enter 2025, there really is a good chance that we might see a drawdown in markets. And so one of the things that we need to look at is, are there stocks that have a high alpha potential that may not, as the year progresses, have a beta that sort of overwhelms that alpha. And so I've got a number of stocks here on my list, which are, I would call them perhaps spice to the portfolio, and they could add some real alpha opportunities. Now, I don't expect necessarily all of them to do well. Some of them are priced quite high, valued quite high, but if even some of them do well, they could add some oomph to portfolio returns. In a way, and we're going to talk in a separate podcast about how to protect your portfolio downside. In a sense, I've been taking my portfolio and doing what you would call barbelling it. And barbelling would be where you're sort of mixing up, having one category of stocks and then a second category of stocks. And the first category of stocks are really my beta protection. And then the second category of stocks are more of the spice. So in this podcast, we're going to talk about the spice. And let me go through a few names, Steve. And
Can you define spice a little bit?
Spice, spice.
Does it have to be
I don't know.
growth rate of 20% or something? Or how spicy do you get?
Well, these are relatively smaller stocks. Some are small cap, some are mid cap. That's not why I'm holding them, because they're smaller mid, but because of the stocks themselves. They tend to be in areas such as data centers, cloud services, high-speed connectivity, renewable energy services, and possibly our newest flavor of the month, quantum computing.
And you are getting spicy, Clem.
Right. And there's stocks that are expected to grow quite quickly, have been growing quite quickly in terms of market cap, as well as in terms of fundamentals like revenues. Some of them, most of them are already profitable. And those that aren't profitable have runway, because if you look into their financial statements a little more deeply, you see that they actually have a lot of cash that they can deploy. So that's one of the things I've been looking at. I don't want to invest in unprofitable stocks that don't have any cash. I want to see that they have a lot of cash. So Steve, should I go through a few of these?
Yeah, let me just try to put it in perspective for the average. I mean, we're not recommending stocks for people. We're trying to help educate people about different stock and how those different stocks can be combined in your portfolio to create what we think is a better balance for the appropriate time and market conditions. I like the idea of talking about groups of stocks, and I think what you're trying to do is look for names that may not be as overpriced as some of the larger names in this space and may have a similar runway in terms of future growth opportunities. And I like the idea of finding some spice, but I also I love the fact that you require, they be profitable and they have some cash. Because I think that when I look at certain names and think this name is really based a lot on hope and not a lot on, actual ability, then I get worried. So I like the fact that you're, putting the additional requirements that it's not just growth for the sake of growth, but it's growth that has some foundation and some track record of performing. So
Yeah,
yeah,
I mean, some foundation, but on this part of the barbell, I'm sort of loosening up the requirements I put on the rest of the portfolio. So I'm willing to go higher on PEG ratios, and I'm willing to go higher on beta, um, and short interest. But the main thing is on the PEG. I'm willing to go higher because these are stocks that in some cases have expected 3-digit growth rates. And
yeah,
so to look at the next 3 to 5 years, may not really be, in terms of forward peg, may
right.
not be really all that sufficient to capture the true value of some of these companies. Now, I'll grant you that there's risk involved in taking that approach, but it's not like my entire portfolio consists of these stocks.
Right, that's what I want to try to get some perspective for
Yeah,
our listeners is it,
yeah,
are
I
you
would
talking
say,
about 50% of your portfolio in these names or 20?
no, no, no. I'm talking about 20% of my portfolio
Right,
would be at max would be in these stocks.
right.
But
That's what I'm
that's
just
enough
trying to get
to
perspective
that's why
on.
I call it spice, right? I mean, it's
Still
not
have some protein and some starches, but you've sprinkled in some other things to make it a little more
correct.
flavorful.
Correct. So let's look at a few of these things. So first of all, uh, there is a company called Vertiv. You ever heard of it?
Curtis?
VRT. Vertiv.
No.
VRT. $42 billion market cap. Makes electrical components for a range of industries. So it's not entirely dependent on advanced technologies. And although it sells into data centers and whatnot, it's got $7.5 billion in revenue, and it's got nice profitability. So yeah, I think that's a good one. And I'm actually already invested in that, right? So that's good. Okay, we've got another company here called Vistra. You ever heard of that one?
No.
Uh, Vistra is, you can think of it as a an up and coming competitor to New Era Energy. So it's a power producer, retail power producer that sells into a lot of different industries. Of course, with all the demand for power that's coming out of the data centers and artificial intelligence and whatnot, there's a lot of the demand comes from there. But Vistra is leveraging renewable energy technologies, and it's got a $47 billion market cap, $17 billion of revenue, and also is profitable. So that's Vistra.
Is
Um,
Vistra considered an industrial? Where would I put it?
it
It's
would
not a
be a
utility, right?
utility. It would be a
Huh?
utility.
It is a utility?
Right. It would be considered a utility.
Okay.
Um, uh, Vertiv would be the one I talked about earlier would be considered an industrial. Uh, but again, it sells into a lot of the more technology intensive industries. Um, you've got uh, you've got a let's see here. Uh, I would say a $20 billion oh wait a minute, sorry. $8 billion company, a market cap called Kyndryl. Have you heard of that?
No.
Kyndryl. So no I's, all Y's, Kyndryl. Cloud services, AI, cloud services for data centers, AI, kind of a uh, tiny little niche competitor to, you know, AWS and Azure and so on. And it's so maybe it's an acquisition candidate for the future, Kyndryl. And it's got, like I said, $8 billion market cap. It's got $15 billion of revenues, and it's profitable. So uh, there's that one. Um,
So,
$11 billion market cap, CLS, Canadian company actually,
no.
but sells around the world, especially in the United States. Supply chain solutions. Now, when I think of when when you think of supply chains, you think of goods, but this isn't a company that trucks things around. This is a company that provides information system solutions to help
Yep.
out companies with their supply chains. So, $19 billion revenues, profitable, um, CLS. So that's one right there. Um, so then we've got, let's see, looking at my list again. Um, I think, those would be the companies that are, you know, I think more easily added to the portfolio. Now, let me talk about the really spicy ones. Okay.
All right.
The ones that I really have to hold my nose to add these if I wanted to. Um, so one that's always in the news that everybody gets excited about, so much so that it's driven up its peg ratios to astronomical limits, is Palantir.
Yeah.
You may have seen news articles about that. I think everybody probably has. So it's a software platform for the intelligence community. Uh, and you know, eh, everybody, well, not everybody. I don't want to characterize this as everybody, but a lot of folks think that, if you've got something that the intelligence community can use, that there's a certain kind of stability to the growth trajectory for that. So it's almost
So
like taking
its customer is the government?
customers, the government, it's intelligence community, I think the defense community too. So it's got that kind of stability that the defense and intelligence community offers in terms of a customer base. But it combines that with advanced technologies. And so
When
Palantir,
you
when I
say
say
advanced
software,
technologies, you mean like it takes data, it
AI,
uses AI to do it?
right? It's AI, it's machine learning AI. And if as you can imagine, uh, the intelligence community and the Defense Department can really utilize AI in some of their data management. So there's been a lot of excitement about this company. But that being said, it's still small. Only $3 billion of revenue. It's already profitable though, and it's got quite a bit of cash, almost $5 billion of cash.
What's the
But
market cap?
uh, here's where the overvaluation comes in. Its market cap right now is $170 billion
Wow.
on revenue of $3 billion. So this has really
Yeah.
been bid up. Its PEG, I believe, is in three. PEG, not PE. PEG is either close to or over 3 digits. So that's why I decided to have to hold my nose to add this one.
Yeah,
But
I have trouble with this, Clem. I don't know where you seem to have you went off the path and now you seem way off the path. I
well,
mean, isn't this a
so
name that we're I like to see names that have potential to
yeah,
expand their clientele.
right.
Now,
Well,
when
this
they
would have to grow quite a bit, okay, in order to grow into its valuation.
right,
So
my
yeah, I
question
mean,
is where does the next client come from, Clem?
I have not added this to the portfolio, but I
Okay.
just keep it on this list because, it might be something that, that our listeners might want to look at. Certainly not, like you said, we're not recommending any of these. And I think this would be one that, I wouldn't want to recommend even if we were recommending, but it's something that I have on my list here to keep watching, right? It's worth watching.
Good. But I
So,
guess my question would be, where do they grow? Like, does the government just use them more and more? Is that what we're hoping,
well,
the US government?
the expectations of analysts are that, you've got seemingly near endless demand for AI within government space. So,
Okay, but
yeah,
it's not
I
endless
can see the
budget either.
skepticism on your face, but that's what you read. I mean, I look at this thing and I guess part of me is skeptical and wondering, well, gee, I wonder if some of these news articles about Palantir are being planted by Palantir itself.
Well, I just wonder, Clem, can they go to the government of Brazil and the government of Japan and the government of Russia and say,
Well,
here's our product. Are you interested? Or
well,
is it?
certainly not Russia. And one of the things
I'm not
that,
sure why, Clem. What's the?
well, you know why? Because we have export controls, and export controls don't apply just to things like, machine guns, right, or missiles. They also apply to AI solutions. So
No.
there are a lot of places that won't be able to buy this kind of
So we'll only sell it to our allies?
yeah, this would be the kind of thing that could only be sold to what are called NATO, to the NATO countries, plus, what would be considered major non-NATO countries like Japan or Korea, for example.
So,
I can see those.
I'm trying to understand the growth long term for this. Like, does
Yeah.
it keep growing as a piece of the US government, or does it keep growing as a piece of a lot of different governments? And therefore
Well,
it has,
I don't know. You're asking me
and
questions
isn't
about
that
its.
multiple telling you it must have, like, I love the idea. I like the kind of technology advantage, but I guess people would, I mean, is there a rationalization of this number based on the fact that it could be exported more broadly to Canada, every one of our allies, and it suddenly becomes the
Yeah,
standard?
you're asking some key questions, and I don't have answers to a lot of these. And that's why I don't have it in the portfolio yet.
Yep.
But it's something that's on my list because a lot of people have put green flags on this and are investing in it. And it's had, immense revenue growth uh, over the last few years. And so they're obviously doing something right. And there's a lot of positive expectations about it. So uh, it's really spicy, Very spicy, right? More spicy than some of the other ones that I talked about. But let me talk about one more. Well, I've got a few more here, right? I don't want to make this conversation too boring, right? But there's one that is, I think, possibly even spicier than Palantir.
We'll be right back.
We hope you're enjoying our episodes. If you are, then we'd greatly appreciate your liking, following, and sharing. Help us help others. Now let's get back to the discussion.
Okay.
And that is IonQ. Okay. And IonQ is a quantum computing company. Now, you might think, what the heck is quantum computing? And quantum computing is as I understand it, right? And I'm not a computer engineer. So, don't hold me to the Charlie Munger. You must understand this completely before you can invest in it. Quantum computing is a highly sophisticated process that departs from the normal bits and bytes that have underscored normal computing to date, and actually allows for looking, for portions of bits and bytes to be used. So as you recall from basic computing, right? Our entire computing structure is based on ones and zeros. And here you can actually have fractions of ones.
Well,
And what this allows is it allows a lot more computing power. And it uses technologies like, spin, and I mean it uses elementary particles, it uses spin. Quantum computing is something that purportedly can break down a lot of it can be used to break cryptograms, break encryption. It's been considered a threat to the Bitcoin algorithm, right? For example,
yeah.
it's one of the considerations that is impacting U.S. thoughts about export controls. So there's a lot of concern about China, for example, getting its hands on quantum computing. But it's very, very new
Yeah.
in terms of a technology, and its revenues right now are only about. And IonQ, by the way, is the leader in the field. There are some other companies that are just, random startups. They might grow, but they're not something I would want to be involved in. But IonQ, $9 billion of market cap. Um, it's got 300. It's only got, okay, scary, only $38 million of revenue right now, from largely from various contracts that have been assigned it by government. But it's got $365 million of cash. So it's got some runway for expansion. But there's a lot of potential growth there. But as I said, quantum computing is new. IonQ, if anything, is more spicy than Palantir is. So I'll just name. I don't want to spend a lot of time on this discussion, but I'll just name a few more stocks without necessarily going into them that much. You've got $20 billion market cap Ubiquity, UI, Internet Telecom Networking Services. You've got 11 billion market cap Credo, CREDO. high-speed connectivity and optical and Ethernet capabilities. So that's an interesting one. And then you have AGX, Argon, which is involved in $11 billion market cap, which is involved in engineering services for power, electrical, and telecommunications. 580 billion. I think 580 billion of revenue so far. So no, $58 billion of revenue so far. So I think that completes my list. So you can see here that I've got some super spicy ones on the list to be looking at, but I have some ones that, are spicy. They're not the Mag 7. They go beyond the Mag 7, as we discussed for this phone call.
Yep.
But they're ones, some of them I have in the portfolio already. Others, I'm just sort of monitoring. Who knows? There might be an entry point for Palantir in the future, right?
Yeah, I think it's good to follow names, and I think it's good to have these like alternatives. I mean, Clem, I've been trying to deal with this whole issue of alternatives. And do you need alternatives? Are alternatives additive in terms of their correlation because they're not traded as much, and therefore companies are able to focus on their knitting and not worry about a blow up in the market on a particular day because the companies are private and they, can live through a lot of things because of their being private. And I keep going back to, well, if it's not priced regularly, it's really not indicative of how volatile it is. And
Correct.
I look at these names and say, maybe these are the alternatives of the future. We previously looked at them as by asset class and said, if you're below 10 billion, you're small cap. And if you're above 10 billion, but less than 40 billion, you're mid cap.
Right.
And that's the traditional kind of way that people look at them. I like when I think about mid cap and small cap, the S&P, the way they construct their indexes is by committee. So they add names that they think reflect the size of the other names in the index and also components of the businesses that make up that space. So I believe that mid cap is an asset class that has a lot of potential because I think that mid caps, if you're looking at a large cap company and he says, I don't have any of this particular type of business, there is a takeover premium for mid cap that allows it to have results that are the same or better than large cap, given its volatility level. And I
So
think from small cap, it's better because it has less
yeah,
volatility because these companies are a little more established with financing. They're a little more established with timeframes. I mean, they've been making money for years. Those types of names in the mid-cap space, I believe, are a sweet spot because they have control over their finances. They have been around long enough, and they have been in the market so that they realize how to be a public company. So I like, the idea of going into these and trying to find the right names. It's just, in my mind, a question of how much do we allocate to it? And
right.
that's ultimately, what we say is a good name is great, but then you got to say, well, where does it go in my portfolio? How do I mix this in?
Right. So Steve, I would not put more than about 20% of my portfolio in these names that we discussed. Right.
Yeah, I mean, I look at it and I believe that you should have somewhere between 10 and 15 in mid cap as
Yeah.
if you look at the S&P, it is made up of mostly the super large names, but I think the number the last time I checked was 13% of the S&P is mid cap. So I think
That-
that if you look at that and say somewhere between 10 and 15 is a guideline for taking some of these names. And
Well,
some of these names might, the $8 billion Kyndryl probably goes down a bit below where you might want to,
Yeah.
put in terms of size. But I love the idea of owning some of the mid-cap names because in my mind, there is a lot of room for them to continue to grow. And if we look at the most efficient way to invest, it's holding names for longer periods of time.
Correct.
So these names you can hold through, they become a 50 billion, 100 billion, 100,
Right.
like you can hold these names for much longer. And therefore, I think you can realize some really great returns from them in this space.
Yep, I totally agree with you. You know, when you talk about Mag 7, you're already, for some of them, above $1 trillion. And, really, how much further can they grow, beyond 1 trillion in terms of share prices,
Right.
before, I mean,
And
really.
I think that's what we're trying to ask people is to think about if you're getting out of one and you still have an interest in that space, because I think the AI space is legitimate. I think the space in healthcare around obesity drugs, I believe is going to be long lasting. I think that genetic engineering is going to cause healthcare to have a lot of characteristics in terms of growth and future that will make it more interesting. It's not the old healthcare of, you're buying some Advil and some bandages from J&J. It's a different world now with healthcare, and I think it's a different world in terms of all of the areas of AI and quantum computing, and some of these things are going to be part of our future. The issue is how do we get exposure to the space such that it is, long lasting? And I would worry if I was taking my 13% in mid cap and I spread it out over 6 or 7 names, is that diversified enough? And that's where I would start to say, your names have some differences, but I would, I would look for, and so what, I'm not recommending any ETFs, but I have for some of our clients used an ETF called FLQM, and they use, very similar to you, certain metrics for determining which names are quality names, which names are good value, and which names have good growth prospects. And so they have a algorithm that they follow.
Is it actively managed, systematically managed? How does it work?
Yeah, it's systematically managed according to a set of rules.
Yeah.
So I look at something like that, and for the average investor who wants exposure to this space but doesn't have the ability to get into the nitty-gritty, as that's a pretty good alternative. And when you look at it return-wise versus the S&P or versus the Russell 2, which for most people to understand, the S&P is considered the benchmark for all of large cap, and the Russell 2 is considered the benchmark for small cap. And I use MDY as a benchmark for mid cap. And so when you look at it relative to those 5, 10, 15, 20 years, there's a pretty consistent outperformance on an information ratio. And we've talked about PEG ratios and, future growth versus current size. And I think that what you're doing with information ratios is you're just dividing by the standard deviation. So, what is the current names, and then how do they look in terms of expected return for the risk you're taking? And since we are in a world where risk matters, I kind of like the fact that in mid cap you get a nice reward for going down in the spectrum and taking smaller names, but that you're not really taking a lot more risk on a risk-adjusted basis than large cap, and you're getting returns that are a bit better. So that to me is kind of the essence of what we're trying to do. Would I put all my money in mid-cap? No. I think that there's too many good names that are in the larger space that have businesses that are almost monopolies. And therefore,
Right.
I think those companies are going to be very hard to unseat. Their moats are very, very wide. And so the moats of these smaller companies are not as wide, but you can see how they're developing, that they have potential if their spaces continue to grow above average. So I like the ideas of, your first four. The next four, I'm a little more skeptical. Is that fair?
That's fair, Steve. You said a few things now. I just wanted to since you raised them, I wanted to touch on a little bit. First of all, I just want everybody to know that I'm not like starting with. I'm not saying you are, but you did raise the issue. I'm not starting with the idea of how much I should have in mid cap or small cap. I'm not thinking about this like an asset allocator. I mean, I do have a background in asset allocation, as some of you know who are listening to this, but I'm not thinking about this portfolio in terms of asset allocation. I'm not saying I want this much in large cap, this much in mid, this much in small. Just not doing that. I'm looking at individual stocks. So that's one thing I wanted to mention. The other thing I wanted to mention, this might be worth an entire different podcast, Steve, is what is risk? Right?
I know.
What is risk? I
We
mean,
throw the word around, you throw pegs around, and
yeah,
I throw information ratios around, and
right.
it
I mean,
ultimately comes down to that question.
there's so many ways of looking at risk. One of the ones that, obviously I settled on is short interest is a really, in my mind, a really good way of looking at risk. But let's take, in my mind, there's three main ways of looking at risk. Putting aside short interest, which I find is a unique characteristic for me, more or less.
Yeah, I think that's
Um,
more of a second derivative.
right. I think, yeah. So I think, the main ones are uh, information ratio, as you talked about, Sharpe ratio and its variation, the Sortino ratio, and beta and its derivatives of like the Trainer ratio, which has beta in the denominator. And I've looked at all three of them. Now, information ratio is interesting, but I think there's a downside to information ratio, at least for the way, I look at portfolios. Information ratio really is measuring against a benchmark. And so if you have a benchmark focused process, like let's say you're working with clients and you're trying to beat a benchmark that, is in your client's investment statement, right? Then, in then the information ratio is a good thing to look at, right? Because it shows how much you're beating that benchmark relative to, the risk around that benchmark, the so-called tracking error, right? So yeah, but I don't look at that, right? I'm not, I'm not, I mean,
Right.
yeah, I
I
look
mean,
at how I'm doing relative to the S&P, but I'm not trying to keep a tight bound around the S&P in terms of move.
I understand why there's weaknesses. I mean, I even go up a level from what you're talking about with some of those names of those ratios and say risk is, are you at risk of not being able to live, or it's going to affect your quality of life if your
Correct.
portfolio goes down?
Right.
Are you
And
looking at the risk of loss, meaning I think that this portfolio is going to make me poorer in terms of I'm going to lose money? Are you talking about risk relative to I expect that I could easily buy the S&P for 6 basis points or 3 basis points. So why would I pay you 50, 60, 100 to manage if I can easily get that return And so I think that some combination of those are what myself and my partner at Circa, look at. But the real thing that comes out of the last year or so is that nobody could have owned the Mag 7 at, more than, they make up almost 40% of the benchmark. And if you made your portfolio in a normal, we try to own positions at 2 to 2.5% apiece, we're underweight what each of those names are in their benchmark. So therefore, we're gonna underperform when those names outperform. And so we tell
And vice
our clients,
versa. In the first 6 months of last year, 2024, those names actually, the Mag 7 actually underperformed.
but I'm talking about the last year and a half. When we look at our performance for the last 2 years, it's really hard to ignore the fact that being well diversified, it just didn't pay off, right? And that's a fundamental part of being an investor is the belief that diversification matters. And if you look at equally weighted, which is what we do, across longer time horizons, equally weighted performs as well or better than cap weighted. But investors look at their portfolios in a 1 or 2 year horizon and say, gee, we're not performing. And that's the risk, is that there come these times when these names have just exploded larger and faster than anybody expected. And they make up a larger portion of their cap weighted benchmarks. And as an equal weighted manager, it's a difficult time for us.
Right.
So yes, I am a bit talking about something that's more relevant to me than it is to the average personal investor who's doing things for their own retirement and their own set of needs and desires. I'm just saying that when you look at things like this, you try to investigate, well, what is it? What else are we doing that we could alter to try to get to a better place? And one of those things in my mind is the presence of or the amount of mid cap that you have in your portfolio.
Yeah.
I think we've become very biased towards the mega caps. And my feeling is once everybody gets on that side of the boat and everybody agrees there's nothing better than the top 7 names, that's when we start to see the boat tip over.
Correct.
And I think that we are going to see the boat tip over this year. Right. And that's why we're having this call, really.
You know what the problem is with there's several problems with the mega caps, but some of them at least. One problem is that you've got the light shining on them. People talk about them, articles are written about them, and fewer articles are written about these smaller companies. You have to dig for information about some of these smaller companies.
Right. I think that we know the Pharma French, looking at value and looking at small and looking at things that are what they consider to be better long-term prospects.
I think there's an information premium associated with looking at some of these smaller stocks.
I also believe, Clem, it's very comfortable for people to say, I own all of the Mag 7.
Yeah, of course.
I have. So there's a cocktail party factor that says I'm into this AI. I'm well, and you say, okay, let's, how into it are we going to be, and how much is it making up of our portfolios?
Right.
I think that's at the fundamental discussion about going past. I believe that we have to first look at income. Is the portfolio providing the income it needs to meet your needs?
Yes.
That's number 1. 2, is it providing growth that will factor in helping you to overcome inflation as a determinant of your long-term value? I think that, being in equities will do that. But I think that if you're looking at it and saying, success is I have to beat the S&P every single year, very hard to do that. And so what I'm trying to do is take a longer perspective and say to people, I think that, one of the ways we're looking into the future is to not just look at the mega caps, but look at some of the mid caps.
Yeah.
And I think that as you think about it for the long term, mid caps have that ability to grow. They usually have good relationships with banks and financing. Small cap, not so much. They usually have profitability. Small caps, not so much. Almost
mega
3%
caps,
of, huh?
mega caps are not without their flaws or their
Correct.
risks.
But right now, you would say, Clem, that everybody believes these 7 names are
Yeah, it's crazy.
Ave Maria,
So let me
the alpha.
give you some examples of some of the risks. Okay. I mean, first of all, you've got Apple, which is dependent whose supply chains of semiconductors and other components are highly dependent on some very risky um, suppliers in Taiwan and China and some other countries. So that's one issue you've got with Apple, right? With You've got with Google and with Microsoft and their cloud services, and with Amazon AWS, these guys are under a lot of scrutiny from the EU and even the US regarding their monopolies in the data area.
Right.
So they're under a lot of scrutiny there. Uh, you've got uh, you've got Tesla, and I just got 2 words for you on Tesla, which is Elon Musk. There's a risk. There's a
Well,
risk right there.
it's interesting you say that because I was just reading this article about, well, that they laid off a whole division of almost 5,000 people because the woman who ran the division wasn't willing to cut her staff because she said they needed those people in order to function in terms of battery development and other things. And so you have Musk, whose friendship with Trump is pretty well out there, and the fact that their government is probably not going to renew the subsidy for buying electric vehicles, which is going to do what? It's going to make it harder for the profitability of Tesla. And what is Tesla doing? He's doing what any businessman does. He says, if my revenue is going to be affected by the lack of a subsidy, I'm going to reduce my cost. And you can reduce your cost. You can get rid of those people. But there's an effect, which is long term, are you going to use the best technology and the best people? If they're not active in this space, does your company still have the same growth prospects? And I would say, if there's less revenue and there's less commitment to some of those areas, there's going to be less results. So, well, Musk and Trump walk down the path and talk about how good things are. It's putting pressure on Tesla, and ultimately, I don't think that the electric vehicle without subsidies, that growth is going to slow down because subsidies matter. The economics matter.
And there's obviously, there are a lot of questions as to just how sound EVs are with respect to the climate, given how much they rely on minerals that have to be, extracted, and where those
Nobody
minerals.
is talking about what do we do with the old batteries. Nobody
Yeah.
is talking about the impact. Nobody ever acknowledges the fact that they're still carbon related, still need carbon coming from the local utility to generate the electricity.
Yeah.
So therefore, they are
And Steve,
not,
the last
non-carbon.
the last Mag 7 I wanted to mention in a questioning way is Meta. And Meta, like the others, is subject to potential monopoly, and also within the EU, issues related to content moderation, disinformation, and the like. But I would just point out that Meta did a kind of a swerve a couple years ago with regard to this so-called metaverse. Put a lot of money into trying to develop the metaverse, and then once they found out that it wasn't such a great idea after all, they swerved back to their main business. I could have told you that the metaverse was kind of nonsense. And I think a lot of people could have told them that it was nonsense. And yet they went in that direction. And for a while, I didn't hold, during that period of time, I did not hold Meta because I was concerned about this, uh, this swerve into a different
Virtual
area.
reality.
Yeah, they're now back and they're doing well. But I think that these, what we've talked about with Tesla, with Meta, with the other Mag 7,
I mean,
I think are, indicate that there are, these are not necessarily all, the greatest, right? They have the benefit of having had a super good run,
right.
so that they have high market caps. They have, strong profitability, but one has to question their growth prospects.
Right. I mean, so let's get back to the original. If we were to sum it up, what would be your points for people in terms of going beyond the Mag 7?
Well, I think that it's useful to be able to look at some of the smaller stocks, let's say under $50 billion market cap, and in some cases under $10 billion market cap. I think I don't think you should invest in companies that have very little revenue. I think you should look for companies that have been building revenue, growing revenue, companies that are have already entered into profitability and have a lot of cash. I think cash is very important for some of these smaller companies because they're still investing and you don't want them necessarily to have to depend on debt. So I think cash is very important. And I think, there's a certain thematic element, obviously, to this. Cloud services, AI, data centers,
Sure.
some renewable energy, uh, and I wouldn't put a lot in any one of these stocks, just a little bit, and I would keep them as a relatively modest proportion of my portfolio. Again, I said something like 20%
Yeah,
of the
I think
portfolio.
I think we're on the same page, just we have slightly different game plan on that page. I mean,
Yeah.
I believe that mid caps as a group represent a good alternative to some of these mega caps and the Mag 7, because I think that you've got firms that have room to grow. You've got firms that have a takeover premium because there will probably be, some larger firm who doesn't have the growth prospects will look to buy them and acquire that growing stream of earnings and revenue. And I believe that when we look at US-based companies who are not doing a lot internationally in this time of a stronger dollar, it could be a nice way for you to take money out of these Mag 7 and put it into something that is going to give you, in the long run, a very good stream of both revenue and earnings. So I think we're on the same page in
Yep.
terms of finding good companies and looking down the spectrum of size. And I think that for most individuals, the first thing is their asset allocation, which would be, I believe that one of the things we haven't talked about is, higher for longer. If interest rates stay higher longer, then that bond allocation, if there is a tip in the boat of the Mag 7 and they fall over, I think having a little bit more in some of your fixed or cash allocation could offer you a good entry point if you haven't already been part of those names. So I think for starting 2025, my advice would be just be careful. Be careful out there. Anything else,
Yeah.
Scott?
Well, I would just say that we're going to have, I guess I would call it a companion podcast, which focuses not on the spice, on the 20%, but more on the 80%, which is focused more on, protection.
Yep. All right. Thanks, everyone. I appreciate listening, and please like and share and talk to your friends about Skeptic's Guide to Investing 2025. Thank you.
The views shared on this podcast represent the personal investment views of the hosts. They are for educational purposes and not meant to be taken as investment advice. Listeners should consult their own investment, legal, and tax advisors. Past performance of any investments is not a guarantee for future return.